being recorded to go online later. My name is Jennifer Turner, and I direct the China Environment Forum here at the Woodrow Wilson Center. I've been hanging out here for 15 years. Woohoo! And a lot of the work that I've done over the years has focused on U.S.-China clean energy cooperation. Of course, that many of you know too, I also work on water energy issues in China and India and other places. But with the China work, I've also done quite a few meetings over the years looking at Chinese investment overseas. And to be honest, those meetings can be quite depressing, right? Because it's talking about the environmental impacts of what's going on in South America or Africa. Even though we had a meeting a couple months ago about Latin America, how it was truly a mixed bag, that there were some positive trends that the Chinese investment was encouraging, that they were working with the government, not destroying the rainforest in certain countries. So those are many of the topics I work on. We also, today though, we have kind of, I think, well, it could be a mixed bag again, but in terms of the looking at Chinese overseas investment, but trying to hone in a little bit more on the clean energy investment that China's doing in the United States. And that said, we're actually going to start off by not focusing just on the United States, but taking broad brushstroke picture, big picture, with Derek Scissors, who is a resident scholar at American Enterprise Institute, where he studies Asian economic issues and trends. He's focused a heck of a lot on China and India. And recently, I guess, kind of relaunched and updated and expanded. It's really pretty now. Your China Global Investment Tracker, which, I mean, not saying it wasn't, technology gets better, but the website's off. They should be getting better every time. And this is this tracker he also had built, he's built earlier on when he was at the Heritage Foundation. And so he's going to start us off today talking about some of the trends that he's been observing in Chinese overseas investment. And then as because we did ask him to look a little bit more deeply on what's happening in terms of Chinese energy investments. And then we're going to shift over to Melanie, a very short shift, who's the Director of China Policy at the Center for American Progress, where she focuses on foreign policy towards China. And she and I have been kind of working together on this issue of Chinese clean energy investment in the United States and looking at some of the challenges. We have a publication that we put up on our website, which has these op-ed type pieces from U.S. business communities about why it's so difficult for their Chinese partners often to invest here. And Melanie, just as we speak, there's something being put up on your website that you're going to be talking about the Chinese clean energy FDI in the United States, and it will be moving in things. You'll show a picture. It won't be moving, evidently, but we'll get over that. And then going from macro to really micro, and a good micro, focusing on the Midwest, where I grew up. We have Damien Ma, who's a fellow at the Paulson Institute, where he focuses on investment and policy programs there. He's actually, I have to do your book plug, is that okay? That he's a co-author of the book, In Line Behind a Billion People, How Scarcity Will Define China's Ascent in the Next Decade. And so today, well, actually, you should let you know, he lives in Chicago now, but before he was in Chicago, where he used to come to my meetings more often, he was a China-Mongolia analyst for the Eurasia Group, where he focused a lot on the issue of policies and markets. And he's going to be honing down on the trends in Chinese investment in the Midwest. Not all of it energy. Energy is a piece. So you're going to come out, walking out of here today with a great snapshot and overview of the potentially mixed trends, but what's going on with China clean energy FDI in the world today. All right, so Derek, this is you. And also I should note that these guys have very short PowerPoint presentations. We're going also rather old school. We might be doing actually more face-to-face talking and conversing. So your job as dynamic audience members is to be thinking of very difficult questions for these guys. Are you ready, Derek?
Yep. So in the line of mixed trends, I'll start off by saying at the macro level, there are some clashing trends affecting Chinese energy investment in the U.S. So you have rising Chinese investment. I'm going to back all this up in a second. I'm just going to give you the themes first. Rising Chinese investment in the U.S., rising Chinese construction of energy plants all over the world. But on the other hand, Chinese energy investment in isolation around the world is falling off a cliff. The Chinese don't really build things in the U.S., and by my standards, meaning the big numbers you see, the big numbers I'm going to throw at you, there's really not much activity in alternative energy. Melanie may say that's going to change, or she may say, well, let's move away from global all sectors investment, and you'll see that there's significant alternative energy activity, but by my standards, there isn't. I don't anticipate in the next few years much Chinese energy activity here. Again, in the global context. The energy majors, the large Chinese state-owned energy companies are getting absolutely, whoops.
Sorry.
I didn't do
No,
anything.
you didn't do anything. You did say you were cursed in terms of that.
That was my own incapacity. Energy majors are getting pounded politically at home. Construction firms, the big Chinese construction firms, are state-owned, and the U.S. is not really had not been an attractive market so far. Private firms in energy are again being drawn back to China. Substitution for coal, probably creating some alternative energy bubbles. And shale, which drew a lot of Chinese investment a couple of years ago, is not really very attractive at current crude prices. I think if I were going to find one source of big number Chinese energy in the U.S., the U.S. accounted for 1/4 of Chinese LPG imports in the first half of this year, second only to the UAE. The number quintupled in on-year terms. So the Chinese will start hunting for partners. They have a couple partners already. They're going to hunt for more. If the U.S. is going to be a major supplier of liquefied petroleum gas to China, you're going to get Chinese investment here to sort of secure the supply chain as best they can. So that's my sort of starting from the big picture. These are the trends. Where do I end up? I end up with, LPG investment. I really don't see that much more. My colleagues on the panel are either going to give a micro view that's different, or they're just going to disagree with me outright, which would be fun. So where is this stuff coming from? It's called the China Global Investment Tracker. I started it in the private sector in 2005. It now has 1,600 transactions of $100 million or more. They're all listed, unlike some of my competitors who just tell you, this is the number. We're not going to tell you where we got it. Certainly the Ministry of Commerce does that. We actually show you the transactions. If you think we're wrong, tell us. That's one of the advantages of being public. The 1,600 transactions in investment and construction are worth $1.1 trillion. I love being able to say trillion now. When I started, the number was like was like 11 billion. So we've increased by a factor of 100. If you look at our series over time, it's very close to MOFCOM numbers, which is somewhat odd because our methodology is different. Our numbers come out first. So, and you can see where they come from. Really not clear sometimes what MOFCOM, Ministry of Commerce, is doing. They have a pretty quick rise in the first half of the year. We have a slower rise, but I think in either case, whether you think our numbers are right or theirs, you should expect not perfectly steady. That's the son of Chinese statistics way, where all their statistics have a stable rise all the time, but that's not actual reality. But you should expect Chinese overseas investment to rise. You should especially expect it to rise if you are, like me, bearish on China at home. I'm a long-term bear on China macro. I called Chinese economic weakness in 2009. Every day that goes by, I walk around grabbing people on the street saying I'm right. And they're looking, who's a crazy guy? I'm like, yeah, whatever. I'm still right. Now, if you're bearish on China at home, you need to be bullish about Chinese overseas investment, because what's happening already and what's going to continue to happen if China doesn't reform at home is money is going to go out and look for higher returns elsewhere. So if you're bullish on China at home, you could turn out to be right. You shouldn't be as bullish about Chinese overseas investment because money is going to be drawn into China. So I'm bearish at China at home, and I think we're going to see low double-digit increases in Chinese investment for the next few years. It's already at a base of, it'll be over $100 billion this year. So those low double-digit increases, you're adding $10 to $15 billion a year. It's a fair amount of money, even by Washington standards. By country, if you look up there, you see the United States is the leader. That was not true for most of the time I did this. It started to be true in 2013. From 2005 to 2012, Australia was the leader. Now the United States is not only leading, but pulling away from Australia and everybody else. That kind of makes sense. The U.S. is much bigger. These numbers as a share of U.S. national wealth or per capita income, adjusted for per capita income and the size of the U.S. population, the U.S. isn't really big at all. I mean, you want to, depending on what measure you want to use, we're 15 times the size of Australia. We don't have 15 times the amount of investment. So in absolute terms, the U.S. is getting a lot of money. In proportionate terms, not that much. The interesting thing that's happened to the numbers recently is, in investment terms, that the commodities producers, China doesn't invest there anymore. Not a surprise. So Canada, no. Brazil, no. Those numbers represent previous investment, not the last couple years. Investment in Russia is wildly overrated by the Russians, which is a problem. Lots of host countries say China's doing this, that, and the other thing, and it's not actually happening. Western Europe, meanwhile, Italy most recently, Britain before that, getting a fair amount of Chinese attention. The Chinese have moved out of commodities, at least for the moment, into things like property and where they can technology, and so it's shifted their countries of choice for investment. On the construction side, and by construction I mean China building power plants, China building railways, China building ports, China building housing on site, so it's local service provided. On the construction side, you really see the impact of Chinese foreign policy. It's not only that you shift from the US, Australia, Canada, Britain, the rich countries to developing countries, but you shift to developing countries where no one else wants to go. Nigeria, Venezuela, Pakistan. And that's Chinese foreign policy. They make friends with people that other people don't want to make friends with. Those countries need help. The Chinese have very, very large, the world's largest construction firms. 4 of the 5 largest construction firms in the world are Chinese. They know what they're doing. And this has started long before the Belt and Road AIIB nonsense that we hear now. Those are not new developments in Chinese policy. The Chinese, funded by China Development Bank, which has now changed its name to like 3 other things, because AIB is just China Development Bank, let's face it. They were funding these projects. Chinese state-owned enterprises were carrying them out. They were going into difficult places. That's what the Chinese are doing now. It's a diplomatic initiative. But the action on the ground has been occurring for years. And you want to see the numbers. Our number in Nigeria is probably too high, but 25 billion in Nigeria before this. Indonesia is mostly construction, the same thing, and you can go on and on and on. We have another transaction which is relevant to energy, which is an art form. These things are taken from Chinese companies themselves or business wires that I trust, like Dow Jones and Reuters. It's where we get the source information. The trouble transaction is kind of an art. And why did I start doing it in 2005? I did it because the start of Chinese outward investment is really then Legend and really Chinese Academy of Sciences, which was the controlling shareholder, buying IBM's personal computer unit late 2004. And we recorded at the beginning of 2005 because I want to, and I'm in charge of the data set, so I get to do whatever I want. 6 months later, the Chinese try to buy Unical. CNOOC tries to buy Unical. They think they're the highest bidder. They think that's the end of the story, and it doesn't work. And it's blocked for political reasons in the United States. And basically, it was made clear to Unical that the Congress was going to make trouble for them if they were bought by the Chinese. Because Americans can't buy a Chinese oil firm, so why should Chinese buy an American oil firm? I'm not justifying that. I'm saying that was the political rationale. So right away, in modern Chinese investment and this surge of Chinese money in the world, you have a big problem in energy. And the troubled transactions data set follows problems like that. It follows things like, we're going to build a railway in Nigeria for $8 billion. Okay, nothing happened at all. 5 years later, we're going to build a railway in Nigeria for $13 billion. Okay, let's see if that actually happens. It's, Huawei's endless complaining, which is mostly self-inflicted, about how they don't have access to the American market. It's the Chinese trying to bid for Rio Tinto, which is a very big mining conglomerate, mostly focused in Australia, and screwing up the bid themselves. It's the Chinese blocking their own acquisitions, where a Chinese company says they want to do it, and the Chinese government says no. So we have that data set as well. There's about $200 billion worth of investments that are impaired or failed for non-market reasons. So all these numbers could be $200 billion higher. Looking at this map for one more second before I move to sectors, this is the best map of its kind in the world, yay, by far. Why? Because the Ministry of Commerce says that the majority of Chinese investment is in Hong Kong. And they say that because Hong Kong is an external customs port in the WTO, and China treats trade with Hong Kong as, we trade with Hong Kong, we're done. We invest in Hong Kong, we're done. Now it's Hong Kong's problem to follow where the money goes. But that's not accurate. The majority of Chinese investment isn't in Hong Kong, population 7.2 million. The majority of Chinese investment passes through Hong Kong onto other countries. So if you look at official Chinese numbers by country, they are wrong. And the Ministry of Commerce says they're wrong, but they publish them anyway. One of the fun things about China. We know our unemployment figure is wrong, but we're just going to keep publishing it. Okay. So our data set is not perfect. It's $100 million and up. So my colleagues are going to talk about smaller than $100 million transactions, which I don't follow at all. It's hard enough. When I started this, it was very easy. Now it's Frankenstein's monster. This is a very difficult thing to do. I had 40 new transactions to investigate on Tuesday, just on Tuesday. Most of them won't pan out, but I got to check them. But if you're looking for country numbers, these are much better than everybody else's because everybody else uses official Chinese numbers that are wrong when we know they're wrong, and the government admits that they're wrong. Now, the big challenge of my presentation, am I going to push the right button? Yes! Okay, I feel like walking off the stage now saying, thank you, I'm done. That is our sector splits. And you can see investment, as I've talked about, engineering, construction contracts, and the troubled transactions. And then these sectors, they're not chosen because I like to talk about tourism. They're chosen because the numbers get big enough. So we just start adding up the numbers and go, oh, we should separate this sector out because it's worth talking about. I'll talk about everything else before energy. Metals is fading. You have a big metals number there. It's the second highest in investment. But the commodities boom is over, and you're getting less and less metals investment. China is acquiring less iron and copper overseas, bauxite. Agriculture and tech, there's notable investment in both. China will continue to try to do that. There are a few countries like us who are sensitive about technology, and most of the world is sensitive about agriculture. So you got to play a kind of game with China, which is, invest in technology in the countries that allow you and invest in agriculture in the countries that will allow you, and they're actually very different countries. I always tell my Chinese friends, you can invest in agriculture here. Don't invest in agriculture in the Philippines. That doesn't work. But you can invest in it here. Technology, no. Go to Spain for that or something. So they're going to continue to try to do that, and they're going to continue to have problems. Right now, property, real estate is soaring. If you live in New York or Sydney or London, there are a lot of Chinese there, and they're buying property, and they're living in those buildings, and so on. That's not going to end well. It's going to continue because we've now had a stock market correction in China, and so everybody who is invested in Chinese stocks is going to look to property. Most of it will probably stay in Chinese property, but some of it will go overseas. So we'll get more property investment, but it's going to end up ugly because that's what happens when people pour too much money into property. Interesting development looking forward. Finance. Chinese financial investments in the US and the UK were very high in 2007 and 2008. Good timing, guys. That didn't work out too well, and they have been reticent, meaning scared to death, since then. We're getting financial investments starting up again. I think we're going to get a wave of Chinese bank acquisitions insofar as it's allowed. So I think finance is something to watch. Transport is mostly about construction. It's second to energy in terms of construction. There's some investment now. China just bought Pirelli, which is an Italian tire firm, which we count as transport. So you can see those numbers. Let me talk about energy. You'll look at this and you'll say energy is the dominant sector. I mean, look at that. It's more than twice the level of investment. It's not twice the level of transport and contracts, but it's 40% of the contract number. That's misleading. Energy construction is continuing. China is building power plants for people all over the world. And in fact, we're going to get more. We're going to get China building nuclear plants, very expensive nuclear plants in a lot of countries. And that's, it's already building hydro and coal and things like that. Now it's going to build nukes. And it may also be building alternative energy plants, although they're much smaller in size. But energy investment is just almost gone by its previous standards, and I'll give you some numbers in a second. We know why energy investment has vanished in the last few years. Oil prices are low. Chinese overspent in light of those oil prices in previous years. There are corruption charges aimed at the major Chinese investors, including you overspent for your overseas oil fields to hide diversion of money to your personal accounts. A couple years ago, I could have been in here in one of Jennifer's fora and said, yeah, I don't understand why Sinopec is spending so much money for oil sands in Canada. They're bidding against themselves. I used to tell jokes about how they were the New York Yankees of outward investment, that they would just bid against themselves. Well, it turns out they had a good reason, because they were spending the money of their personal bank accounts. And the bigger your bid is, the easier it is to divert money. Now, I'm not pointing fingers at any particular company or particular person, but a clear pattern. And that is a real problem for China trying to invest outward now. There was a delayed hydropower acquisition apparently in Nepal. If you take that out, because it's really only occurring in the first half of 2015 because of a delay, you have $2 billion in energy investment in the first half of 2015. In the first half of 2013, it was $15 billion. That is a big drop. And in that respect, the fact that Chinese investment continues to rise is really impressive, because the core of Chinese investment used to be energy, and it's not anymore. It might be again, but it's not now. Power plants, I've already talked about. The nuke surge is coming. An example, the series of power plants in Argentina. Power construction cores, main overseas subsidiary is Sino-Hydro. Sino-Hydro is everywhere. And Power Construction Corps is one of the biggest companies in the world. And there are other countries, Sinamok, China National Machinery, builds power plants as well. These are really big companies. They build power plants in a lot of places. Go to there's an Excel file that has all the transactions. We have 800 construction contracts. Energy is by far the single biggest sector. I'm not going to read them all. Go look. Alternative energy is a very small part of this globally. That will change. It will change because China is shifting its energy mix at home, which we could have a long discussion over, which would be very interesting, but we're not talking about that today. And in the Chinese way, the shifting of the energy mix at home means they're going to build up too much capacity in alternative energy. In every single element of alternative energy, China will again build up too much capacity. It's already done this once, and it will do it again. And in the spirit of the AIIB, the whole point, if China has too much capacity, is export it overseas. So we're going to get too much alternative energy capacity in China. I'm happy to see the substitution for coal, but it'll overshoot. And some of that will go overseas. And so we're going to get China sending its alternative energy capacity overseas. We're going to get more alternative energy investment. There are just obvious patterns in Chinese investment. This is obvious. It's going to happen. It's just a question of timing and magnitude. Finally, the U.S., and then I'll be done. So Chinese energy investment in the U.S. since the shale boom, where they were trying to acquire U.S. shale technology, it's nothing. Just 2 years of nothing, really almost 3 years of nothing. At the level I'm talking about. I really don't see, and maybe Melanie will correct me here, attraction on the Chinese part to large-scale alternative energy business in the U.S. We don't subsidize, which I'm very thankful for because I work at a free market think tank. We really don't like subsidized Chinese firms coming in and taking market share. That's, you can start off here. If you take too much of the U.S. market and you're subsidized, you're going to get in trouble. And the big thing, the big econ story, which is not policy, is natural gas is cheaper here than anywhere else in the world. And so, where's the space for alternative energy to expand here compared to other countries? So I'm not expecting a big Chinese alternative energy footprint in the U.S., even though I'm expecting an increasing Chinese alternative energy footprint around the world. Again, this is in the context of really big numbers. So, if you get $500 million in Chinese alternative energy investment in the U.S., some people might think that's big. By my standards, it's not. Doesn't mean it's not important. Certainly can be important to a county in the Midwest. But I don't think we have the environment for a breakout of alternative energy here, at least not for the next 5 years or so. I'll stop there.
Okay. So, well, that's, I'm always really sad when speakers don't really assert themselves, and this is good. This is good. And I've gathered a lot of questions, but hold on to your questions because I want us to keep the flow coming down to Melanie here, going macro to, I guess, meso. All right, Melanie.
Thanks, Jennifer, and thanks, Derek. So I'll drill down a little bit more and focus specifically on the United States. When you look broadly, you can see that there have been some interesting shifts in Chinese energy investments, and I'll talk a little bit more about how that impacts the U.S. directly. I work for the Center for American Progress. We tend to be on the opposite side of the political spectrum from Derek's shop. So we're a little more bullish on clean energy than Derek tends to be. And I think we've been proven right in the past couple of years here in the U.S. And so, I spend a lot of time talking to Chinese companies, some of the Chinese companies that have made some of the investments that Derek's talking about, and some of the U.S. companies that are working with them. And we started out a couple of years ago wondering how much is really happening here with Chinese investment in the U.S. energy economy? Because there are some big media stories. The Wanxiang acquisition of A123, everybody knows about the failed CNOOC acquisition of Unocal. There have been state-owned oil companies buying oil assets. But usually all you see is just a big story that's somewhat scandalesque and then dies down, and there just wasn't really granular data on those deals. Derek was providing the spectacular granular data on the big picture globally, but we wanted to find out more. What exactly is happening? What does the landscape look like in the United States? And are there any needs that aren't being met by current federal policy? So what we found out very quickly is there isn't much of an understanding of what energy investments are out there across the United States. There's no public data set that drills down on smaller Chinese energy investments. There are some proprietary ones that aren't shared in a detailed way. And even some of the energy news services we found out that they didn't have much in their databases either. So we started building our own. And we focused on some of the projects that are significant enough for us to be able to triangulate sourcing, not something that was mentioned once but never mentioned again, and projects that include direct Chinese investments. So that means where a Chinese firm acquired a U.S. company or built a greenfield project or partnered with a U.S. firm. And we found a couple of different things. First of all, there's a lot more than you would expect from just looking at the few big stories in the mainstream press. We are looking at over 60 pretty major projects, major from the perspective of the local governments that are working for them. We found that there are some interesting clusters around the United States. We found 3 interesting clusters. One is that clearly you have the oil investments marching through the areas of our country that have rich oil and gas geological reserves. Where there are oil assets, some Chinese companies are interested to invest in them. But those projects don't really create much in terms of jobs, and they don't tend to come in and fill a missing hole in the economy. It's not the case that we saw Chinese firms coming in to save a bankrupt energy company, for example. It was more chasing after the same assets that everyone is chasing after. So you see examples of a Chinese oil major and a Saudi oil major bidding against each other for the same fracking assets, for example. Secondly, you see some interesting clean energy clusters in the states that have good clean energy policies. So if you look at California, there's a very large cluster of solar. They have solar projects. They have some vehicle projects, particularly solar and vehicle, but also some smaller things as well. New Jersey is a strong leader in solar. New Jersey might not be what you would expect to be a solar leader. It's not Arizona or Nevada or California, but they have great policy. And what we saw is that where states have great clean energy policies, all investors follow, including Chinese investors. And that includes Texas, actually. Texas is obviously a fossil fuel leader, but Texas has spectacular wind policies. So Texas is leading the nation in wind, and they have over 17,000 jobs in the wind sector in Texas, and quite a bit of investment, including Chinese investment. So there are some clusters around states that have the policy right, and there are also clusters around areas that have strong networking programs. If you have a local mayor in a city that needs a new utility project or needs some generation projects and thinks that it would be wonderful to partner with Chinese companies to do that, if that mayor has never been to China, doesn't know any Chinese energy companies or know how to reach out to them, they're really not going to be able to engage well and attract those investments. And areas where they have either a sizable Chinese population, some direct investors already in place, or state and city level networks, it's very difficult to do that. Where states and cities do build up those networks, they can be amazingly successful. California, again, is in the lead. The city of Los Angeles has a program focused specifically on attracting Chinese direct investment. That program has made Los Angeles the second largest municipal attraction zone after the city of New York. The city of San Francisco has a special program called China SF that they have dedicated staff to helping bring in Chinese companies and help San Francisco companies go out to China. Those programs are enormously successful. And what's interesting is you start to see some networking beyond those cities. So for example, we looked at a case study in Lancaster, California, where the mayor of Lancaster was invited to join a dinner organized by a council leader of Los Angeles that was part of the Los Angeles program, and LA helped introduce him to BYD, the Chinese vehicle company. And he used that connection to bring BYD into the city of Lancaster, and BYD built an electric bus manufacturing plant there that the mayor and the local citizens were thrilled with because they're providing jobs and most critically, manufacturing jobs. So some states recognize that they are punching below their weight on attracting Chinese investments, and that it's because they have pretty good policy on the energy side, but not enough in terms of connection networks with Chinese companies. One of those states is Washington State. So Washington State is rolling out a new state level and Seattle city level investment attraction policy that will set up a China Seattle modeled on China SF. And the goal of that organization is going to be to create some bridges between the city of Seattle and key investors in China. So if you have some neighboring cities or counties or a U.S. enterprise that has a cool idea but not enough capital, they can help them reach out to Chinese partners that have cash and that love to know about good investment opportunities in the United States but just don't quite know how to find them. So we definitely saw there can be a huge amount of opportunity. There can be great win-win projects, but it can be difficult to make that connection. And just to give some idea of the type of projects, we basically see in the United States projects breaking down into 3 types. One is the greenfield investments, where a single Chinese firm comes over and builds something that didn't exist before. For example, Wanxiang built a solar panel manufacturing plant in Rockford, Illinois. People in Rockford, Illinois think that is fantastic. They're hiring local workers. They found that nail technicians are great at manufacturing solar panels because they're used to really detailed work. So there are nail technicians in Rockford, Illinois that are now solar experts working for Wanxiang. BYD built the electric vehicle manufacturing facility in Lancaster. Chinese companies have come in and built wind farms and solar farms. They are creating value and creating assets and hiring workers, and they're creating something new that wouldn't exist without them. And that's the easiest to understand picture, I would say, of how these investments can be a win. It's important to note, though, that even when Chinese firms are partnering with an existing U.S. firm or acquiring an existing U.S. project, either in whole or by buying a stake in the project, those deals often create lifelines of financing for U.S. companies and U.S. projects that might not be able to go forward without those Chinese partners. The U.S. clean energy, this is particularly important in clean energy. U.S. clean energy development started to take off right around the time of the global financial crisis. So that meant all the lending disappeared for everyone, regardless of the sector. And so a lot of the clean energy projects that were trying to get off the ground found that venture capitalists, hedge funds, they weren't spending any money. And the banks saw clean energy as risky because it was still relatively new technology. So to the extent that banks were willing to give a loan, the interest rates were high and the terms were short. And it's really hard to build a solar farm and pay off a very expensive loan in a short amount of time. Those are usually longer term investments. And so it was basically impossible to get a project off the ground using U.S. lenders. But some Chinese banks were perfectly willing to come in and finance those projects because the Chinese banks have state backing, so they have a different risk portfolio. They're very happy to support, to offer longer loan terms. China also has focused on clean energy from the top down much more strongly and more early than the United States has. So a lot of the Chinese state banks saw clean energy investments around the world as a great strategic opportunity. They wanted to be involved in those sectors. They thought those sectors were going to be a win. So they weren't as deterred by some of the new technology risks as the U.S. firms. Now in 2015, we're recovered from the financial crisis. U.S. banks, hedge funds, venture capitalists have seen that clean energy is growing strongly in the United States, compete even in an area of cheap shale gas. So a lot of our lenders and investors are very bullish on renewable energy. If you have a clean energy project in the United States that's a solar farm, a wind farm, installing proven technologies, it is much easier to get financing, but the breakthrough technologies still really struggle. If you're trying to deploy something quite new or deploy existing technologies in a new way, the US funders are still very likely to get cold feet, and China can again still be a lifeline for those projects. I think one of the best examples right now is the Texas Clean Energy Project in Pinwell, Texas. Summit Power is deploying a combination of clean coal technologies that have never been integrated in one package before to build what stands to be the cleanest and the largest clean coal project in the world that would capture or utilize 90% of the carbon that project emits and create power for San Antonio, Texas. Again, it's in Texas, in an oil state, which is fantastic. But that is a project that found it very difficult to secure financing from the U.S. banks that get nervous with these new technology ideas. But China Exim Bank was willing to support this project. So China Exim Bank has offered a $1.8 billion loan to build this project in Texas. Part of the terms of the deal is that in exchange for access to that capital, which is at a good interest rate for a long term, Summit Power is partnering with HQC, a Chinese energy engineering and services firm, to help build the project. So China Exim Bank is able to make that loan because some of the payments are going to go to a Chinese company to build that project in Texas. A lot of the money is going to stay in Texas because Texas gets the plant, which will be hiring workers and producing clean energy, and a lot of the components are going to be purchased locally, but some of the services are going to come from the Chinese side. So that shows how you can still partner with Chinese service companies and Chinese lenders to create something in the United States that it wouldn't be possible to create otherwise. And so today, the Center for American Progress is launching this interactive map. For each of the icons, you can scroll over and a case study will pop up. So you can see what is this project, who is involved, who's the Chinese firm, how much did they invest, and we try to provide a little bit of the backstory for the local government as well. One thing that we found with all of these projects is that this is a local government story. This isn't a federal government story. It's not the case that the Department of Energy is going out and picking a site and picking a Chinese investor and pushing these forward. It's the case that a mayor is going to China, in some cases 5 to 10 times, to court Chinese investors and bring in money and bring in jobs for their city. You know, there's some interesting quotes from some of these local mayors. You know, they're saying, this is hard. We are working hard for these projects. And when we talk to some of the state level economic development offices, they say, we're really struggling. You know, you see that we have some good successes, but we'd like to have a lot more. And there are a lot more projects that we just can't quite get to yes, or we can't quite figure out, you know, who the best investor is to approach on the Chinese side. And you know, I completely agree with Derek that we've had some really interesting activity in the fossil fuel side. If you look at the pattern of fossil versus clean energy investments in the United States, the fossil investments are really on a boom and bust cycle. When oil prices are strong, when they look like an easy way to make money, when it looks like an asset is high performing, the Chinese majors rush in with everybody else and buy up oil assets. When the prices crash, they rush out with everybody else. So that isn't really a stable foundation for economic growth in the United States. If anyone wants to come in and buy U.S. oil assets, if that doesn't threaten U.S. national security, hey, good for you, great. You know, and some of the oil firms that are receiving those investments are delighted because that gives them more capital to expand their research and development and drilling. But those projects aren't hiring local workers in large amounts. They aren't building new infrastructure, and they're on a boom and bust cycle. So those projects are fine, but that's not an area where local governments need help to bring them in. This is oil company business. That's also not an area where it makes sense to focus on policy to try to expand those projects because they'll just go with the market. We see clean energy as an area where it does make sense to expand and try to help some of these local governments because you can see that there are states across the nation, regardless of what they have in terms of geology, anyone can be a clean energy leader if you get the policy right. And anyone can bring in strong clean energy Chinese investments if you get the policy right and make good connections. And the connection side is where we see a good opportunity for the federal government to really up its game and play more of an advisory role to help the local governments, both states, cities, and counties, and enterprises that think they have a really cool idea for partnering with a Chinese firm or a Chinese bank, but just don't know how to go about doing that. And that's where we have a really great growth area here in Washington and around the U.S. In 2011, the Obama administration founded the Select USA program. That was the first federal government program to help with investment attraction. Previously, all we did was block projects that the United States didn't like. Understandably, that didn't give us a good rep in the world of foreign direct investment. It looked like our only policy was a throw up a stop sign policy. Since 2011, Select USA has been trying to figure out how do we coordinate this messaging to explain we are open for business. And despite what you might see in the news about Huawei or Unical, there's a lot of great stuff going forward, and we want Chinese investors and other investors to come here and create jobs. You know, Select USA is doing great stuff. They're holding summits. They're helping local governments connect to Chinese investors and other foreign investors, but they aren't industry specific. They don't have an energy-focused program. And in the energy sector, that's a problem because these projects are very technical. The types of policies and investors that make sense for a coal project are not the same as the ones that make sense for a wind project or a solar project or a bioenergy project. What we hear from a lot of the state and local governments is the kind of help they really need is for someone to come in and look at their needs and say, okay, you should go meet these 10 Chinese companies because we've been talking to them about their needs and we see some overlap. So come out to Beijing, come out to other areas of China. We'll help set up those meetings for you. This is who you want to see. That isn't available now in big picture terms. There are some really awesome people at the U.S. Department of Energy and at the U.S. Embassy in Beijing that do that kind of thing on the side. You know, if they hear that someone's looking for a good connection and they have had some ideas come up on the Chinese side, they'll try to introduce people and help make those connections. But it's just, you know, a particular one or two people trying to do that on the side on top of their regular job. And the average mayor or governor doesn't know how to reach those experts working in Beijing or Washington, and those experts certainly don't have time to be taking meetings from 50 states and from even more cities and counties to try to do some matchmaking. What would be really wonderful would be to have a small team of people that can provide that service to local governments across the nation, because the U.S. and China already have a fantastic clean energy partnership. We're doing all of these projects. We're developing these great network connections. We're developing so much deep information on the US side about what's happening in China, about what different companies are involved, and about where there might be some new interest to invest in the United States. So why not leverage that existing program to help support our state and local governments to reach out and find Chinese partners when they want to do so? You know, if you can see that there are some states that don't have much activity going on. You know, some of those states might not be interested. Great, fine. You know, make your own choices, but some of the ones we talk to really want help, particularly the states that don't have oil and gas. You know, I remember someone from Connecticut at an event that Jennifer and I organized saying, what about Connecticut? What do we do? So for those states that have an interest and a demand, it's something the governor wants, the mayor wants, the local people wants, why not leverage what we're building at the federal government level to really give them some new tools in their toolbox? And we'd really like to see the Select USA program extend to bring in more of those Department of Energy experts and hopefully create a team to help leverage some of the information and connections we already have. Would also like to see Select USA do more research to determine what are the strategies that work at the local state level and which comparative advantages enable a state to employ certain strategies over others. What we're hearing is that the current program is sort of a one-size-fits-all approach. There are websites you can post information on to try to attract Chinese investors. There are meetings you can go to. You can, go to Shanghai or Beijing, and the Foreign Commercial Service will bring in a bunch of companies to meet you, but it's not targeted. And a lot of states want to know what worked for states like me, and where should I focus my very small resources to try to achieve the same success here. And we see those as really great growth areas, and we'll be doing our best to bang that drum going forward. Thanks.
So it kind of sounds like you need like an eHarmony for local governments in the U.S. We'll call it energy harmony. All right. Now we're going down even further. Focus in on where I grew up, the Midwest.
So while this is being set up, I think this is a great segue because, as Melanie said, a lot of the action on investment happens at the local level. It's less of a federal story, and I used to be in D.C., so I had heard all this stuff about the politics of Chinese investment and so on. But now I'm outside of the Beltway, and I'm in Chicago, in the Midwest, and it's a very different story, right? There's not as much sort of, Washington, D.C. type of politics when it comes to Chinese investment. In fact, there's not much distinguishing. They don't tend to distinguish between Chinese versus Japanese versus German investment. Just any job-generating investment is good investment, right? So I think it's very much the case that things are happening much more at the local level, and this is why I think this is a great complementarity going from a really terrific macro overview, Chinese presence, globally, to the U.S. in a specific sector and also regionally here, which is what I'm working on at the Paulson Institute. And just a little bit of background. I don't know. Some of you probably don't know what the Paulson Institute is, but it's a fairly new startup think tank based in Chicago at the University of Chicago. It was started by the former Secretary of Treasury Hank Paulson. For those of you who don't know, but if you were here during the financial crisis in 2008 in D.C., you probably know who he is, because he was very omnipresent during that time. In any event, so we wanted to do something on cross-border investment because I think we would all agree, despite the political spectrum difference here. And by the way, I take no position on clean energy versus fossil fuels, but I think the operating principle, I think we would all agree that Chinese direct investment is generally a positive thing for the U.S.-China relationship in general. Given all the other nasty stuff that's happening in a bilateral relationship, this could serve as a new anchor in the commercial relationship. And it's more interesting because the bilateral trade relationship has progressed for quite some time, and it's much more well understood. But this investment thing is happening just now, and there's a lot more money waiting on the sidelines to come into this country from China. So I think it's a newer story, and I think a lot of us are trying to grapple with it. So it's just a good time to think about how that might work and how it may actually serve as a new anchor in the commercial relationship. So the Midwest. As you can see, I'll just preface that I'm going to keep it very short. I may not even go through all my slides. I think we would all prefer not to be talking at you directly and just have you guys, discuss and interact with us after my presentation. So you can see, other than the Rocky Mountains, right? It's the Midwest, basically. We call them the Great Lakes states. It really punches below its weight in terms of attracting general FDI. Okay, it's as Melanie has said, the far west, California, Texas, some of the big states really have done a much better job in attracting Chinese investment, in part because they're much bigger states. The Midwest, not so much. And here's just another breakdown. You can see that the top are sort of overall FDI, and then the bottom is sort of specifically Chinese investment. And obviously, the big states, New York, Texas is up there, but you can see basically Chinese investment is dominated by just a handful of large states. Virginia is a little misleading. That huge value in part is because of one deal that happened not too long ago, the Smithfield acquisition. As you can see, Virginia only has about 7 kind of deals, but the value is huge because of that particular one, deal. So that's a little bit of a aberration in the data. But basically, if you look at the Great Lakes states, other than New York, everyone else just is very behind the times. And they need a lot more help than a Texas or California or New York. And what's good in the Midwest, right? It's the old industrial Rust Belt. It's the manufacturing hub of the United States, or at least traditionally everything from Detroit to Toledo to Chicago. So that's an area that I think obviously makes a lot of sense for both Chinese investment and also inherent advantages in the region. And obviously, manufacturing is huge and broad. You can't just say manufacturing and expect people to actually know what to invest in. So that's sort of a little breakdown of the different aspects of manufacturing. Ideally, you want Chinese investment to be in the upper right-hand corner. Quadrant, high growth plus high job concentration. Again, local governments care a lot about jobs and keeping jobs in their states or in their cities. So anytime you can sort of say these things will generate jobs is a good argument, or certainly better than just a typical sort of acquisition type of investment. So ideally there, but not necessarily limited to that specific quadrant. Let me just go one more. And as you can see, so 45% of FDI already goes into manufacturing. Okay, I don't want to get, but that's just a macro way of looking at it, and there's some other stuff there. But
And this is all Chinese FDI?
No.
That's all FDI?
That's
okay.
overall. That's overall. China, but here's more breaking down to, again, so as you can see, there's just 3 divisions. The Midwest is about 1/3 of U.S. manufacturing GDP. But it only gets about 16% of Chinese FDI into Midwest manufacturing. So it's not very proportional to the size or to the actual weight of the Midwest manufacturing on economy. So there's a lot more that can be done to raise that number in the Midwest. One key thing we have found that a lot of small and medium enterprises and mid-caps, so the $100 million companies or even smaller than that, are really concentrated in the supply chains in manufacturing. And as Melanie said, and I would totally echo her point, it's much harder to find those entities. It's much harder to do those investments because capital markets are pretty efficient for the Strongways and Smithfields of the world. They can find each other pretty easily. They're big. Goldman Sachs, Morgan Stanley can do those deals. But when it comes to these smaller companies, in the Midwest in particular, it's really hard to find them. And it's equally hard for these companies to find willing investors on the Chinese side if they're private. How do you get some random private investor in Henan to find a auto brake supply chain in Ohio? It's extraordinarily hard. So that discovery process that Melanie talked about is something that really needs to be solved, especially for this group, for this cohort. And they seem to be concentrated a lot in the Midwest. And again, one thing we also discovered is that China is obviously trying to climb up the value chain. And just as I think a lot of people are sort of thinking through how technology will disrupt, to borrow Silicon Valley's word, the manufacturing sector. And they, the Chinese want to compete in virtually every single area that are basically on advanced manufacturing. In fact, they came out with recently the Made in China 2025 huge industrial policy plan, which was basically copied off of Germany's Industry 4.0 plan. And it basically matches everything that's on here. Advanced materials, robotics, digital manufacturing, processes. So these are the things that are happening in the Midwest because, again, of the concentration of manufacturing. So there's some inherent complementarities. If you look at what the Chinese have put out in terms of their industrial policy, it's matched pretty well with what's happening here in the United States. And I know Derek says, technology is a no-no here, but unfortunately, the Chinese really want to acquire technology. They don't really need capital anymore. They're no longer a capital scarce country. They're a technology scarce country. So what they want is to use their abundant capital to buy technology. I'm not going to go through all that. I'm not really going to go through all the factors. I mean, that's pretty clear. I think Derek has already talked a lot about that, so I won't talk too much about it. And again, this is somewhat old because this came out in a 12th five-year plan. It's already been superseded by what I just talked about, the Made in China 2025 plan, right? So the Made in China 2025 has 10 sectors, which overlaps somewhat with the emerging industries one, but it also, I think, falls back on some legacy industries that are in the present now, not just sort of, what's going to happen in 5 or 10 years. But in any case, you can see, again, it matches with the previous slide on advanced manufacturing. A lot of this stuff has inherent complementarities, and that's where the Chinese money would like to go as well. Just to drill it down even more to very local Chicago, one idea in Chicago is this project called Goose Island. So it's literally an island in the middle of the Chicago River, and Chicago is an old industrial town in some sense. And this is sort of, if you can think of it as a special economic zone, right, to steal China's idea. You basically built this up, and I think the Obama administration, the White House has funded an advanced manufacturing institute already. It's already housed on that particular island, and Amazon's got its factory there too. So there's a lot of things already happening on this island, and if local governments, not just Chicago, but other governments can sort of define these sort of innovation-driven investment zones, that I think makes it very clear to the Chinese where to invest, because that's something the Chinese understand because they have SEZs in China, and so basically it's an interesting way to formalize something like this within a city. And I'm not saying just Chicago, but that's one example here in Chicago. You can do it in Ohio or somewhere else, and that's a way to sort of bound the geography and say this is where we want to really promote on investment in the city. And again, I think that would play well with the Chinese, and And we've already spoken to some Chinese investors who are somewhat interested in this idea of doing, advanced manufacturing in Chicago. And again, to illustrate, this is another an investment from a Chinese investor. I got it cleared. He said it's public, so I can talk about it. This is the type of stuff that they want to invest in, right? This is a company called Icon Aircraft. It's being manufactured right now in San Francisco. It's basically being marketed as the Tesla of the private aircraft industry. It's designed by a guy that used to do the Virgin Richard Branson spacecraft thing. So basically, Chinese investment, I think they have a majority share, and they are going to basically take that stuff back to China. It's a bet on the PLA will liberalize their airspace. And this one airplane it can land on water. It can be towed behind a truck like a motorboat. It's cost about $200,000, so seems like a lot, but there's plenty of high net worth Chinese individuals who can buy that. And that's what the Chinese investor is banking on, that he's going to basically brand it and sell it like an Apple computer or a Tesla back in China. So it's made here, but I think eventually they would want to manufacture back in China as well. So it's these types of stuff. And there's plenty more examples. We've done some case studies as well. I won't go into them in detail now, but this is the area that the Chinese are most interested in. And I'll just end on one final note that I think really resonated with me from what Melanie said is the inherent complementarities in terms of basic R&D here in the United States, but deployment back in China. You can call it R&D plus D. Research and development plus on deployment. There's a lot of Chinese who are interested in early stage nascent technologies that may be just too expensive to commercialize here in the United States for various reasons. But China has its market power. It tends to commercialize technology much faster than we can because it can make things cheaper and things go much faster. Just look at the internet and mobile phones as one example. So that's just an inherent advantage that China has that we don't have. And if a savvy Chinese investor can sort of put money in early stage technology startups and kind of bring that back into China that would have applications in China, and they could drive down that price probably faster than we can at this point. So that's just an interesting way of thinking about how investment flows might go. And finally, in terms of the matching discovery process, I think you're right. You need a sort of a Tinder for cross-border on investment. And I think one of the things we're doing with the state level is we're trying to do a pilot project to basically help them design a technology platform, some kind of an app that basically makes
Dating app?
Sort of. It's just basically, rather than B2B, rather than business to business, it's sort of I to A, so investor to assets. So there are a lot of, local political problems of local companies going into, these sorts of databases. But basically, the idea again is very much about, I guess, how we would describe it as turning the lights on. Most Chinese investors don't even know. They're kind of like shooting in the dark. Same with small mid-cap companies here. So they really need the lights turned on both sides. And part of that, maybe through Select USA, maybe through other councils, but possibly also through a technology platform that can make it easier for just individuals to kind of find each other. And I will end right there.
Yeah, and we can leave your picture up because it's kind of a pretty backdrop. Yeah, well, okay, some quick or long applause for these guys. They're excellent presentations. Seeing a few themes emerging that, I'm going to ask one question, then open up to you guys and let myself be interrupted if need be. It kind of seems like the matching question, like when we're talking specifically at the U.S., finding the kind of partners. And I like the image of turning on the light because Melanie and I, when we had a couple meetings, some closed door meetings and chats with lots of people, that the Chinese investors sometimes seemed, it's kind of naive about how to even engage with the U.S. states. And then they'd trigger that lovely CFIUS process that maybe one of you, I don't know, Melanie, do you want to talk a little bit about that, about how Chinese companies have tripped and gotten in trouble, with the federal government? So, yeah.
Sure. So, with the first wave of Chinese investment which in the energy sector is marked pretty strongly by the spectacularly failed Sinopec Unocal acquisition. You've seen a lot of Chinese firms kind of coming over and trying out what it's like to invest in the United States and trying out different strategies. And in the first wave, a lot of Chinese companies approached the U.S. the same way they would approach China, which would be try to get very high-level political support. Try to get someone to bless your project, and that isn't quite the way it works in the United States. We have a pretty serious and detailed regulatory legal system that stipulates very clear step-by-step processes that you need to get a big deal through. And one of the big elements of that for any foreign direct investor is CFIUS, the Committee on Foreign Investment in the United States. And that is a program designed to block or modify transactions that could pose a security threat to the U.S., particularly that could give a foreign government control over a strategic U.S. asset. So CFIUS in general is not supportive of a Chinese government-controlled entity owning bits and pieces of the U.S. electric grid. Because in theory, if there's a future U.S. conflict, that entity could shut it down. And that would be a national security risk for the United States. So in most cases, if you want to build a wind farm, that's not going to be a risk. Of course, then Rawls Corporation found out that if that wind farm is next to a drone facility, then it might be blocked for those reasons. So you've seen when Chinese investors first started coming over here, first of all, the U.S. didn't have any policy on attracting investment. There's no policy that says these are the green zones, these are the red zones. Companies would just give it a shot and see what happens. And some of them were blocked by CFIUS. And over time, we've developed this really cool pattern where now companies know this type of deal is going to raise a red flag, this type of deal is going to be green. It's going to get a green light. Or if you're going to do something that's edging towards a security risk, there are now a clear precedent of steps you can take to mitigate those risks and get CFIUS approval. So for example, when CNOOC acquired an oil lease that was near a U.S. naval facility and near critical underground communication cables, CNOOC just said, okay, we're just not going to decide. We'll let our U.S. partner decide where the drill goes. And so, CFIUS approved that transaction. But in general, I think at this point, the security issue has become pretty overblown. A lot of Chinese companies look at the U.S. and look at some of those big, high-profile CFIUS blocking cases and think that it's very hard to do business here. But what we found talking to Chinese firms and U.S. legal experts is that part of those problem cases just emerge from a lack of understanding about how to do business in the United States. For example, the rule in Washington is you don't want to surprise people. So if you're going to do a big investment in the U.S., go talk to the federal agencies involved on the CFIUS committee and give them give them a preview of what you're planning. Ask, do you see any areas of concern? How can we moderate those concerns? Basically, the best strategy is to be very forward-leaning and upfront and transparent and try to find out in advance if there are any aspects of your business model that are going to flag concerns, and then adjust those aspects of the model so you can get approval. And some companies have been really great at doing that, both in terms of CFIUS and with local governments. One of my favorites is ENN. ENN had a project in Clark County, Nevada, that was on track to receive some discount land from local government in Clark County. And it didn't pose security risks. CFIUS wasn't an issue, but there was some local political pushback over the idea of giving discount land to a Chinese company. So ENN participated in some community roundtables to hear local citizen concerns. And in response to those concerns, they said, okay, in exchange for that land, we promise 1,000 jobs. We promise to buy everything locally, and we're going to set up our contract so that if we can't meet those promises, then we're out and you get your land back. And unfortunately, that project wasn't able to obtain its power purchase agreement, so they lost their contract. But I see that actually as a great success story because the local government structured things in a way that worked for them. The Chinese companies structured things in a way that worked for them. And if the deal doesn't go forward, okay, you just divest the partnership with no losses on either side. And because ENN went in and made Clark County such a big news item, now 2 U.S. solar firms are bidding for that land package. So it can be a great story for both sides when the strategy is done right.
Derek, you.
Yeah, I'm going to add to what Melanie said. I agree with that. I actually love the NN story because there was a major U.S. political figure walking around saying that that investment was going to be at least 10 times larger than it actually was. So that's a nice illustration that the U.S. side gets facts wrong sometimes. And that's true in all the host countries. They will say this is going to happen, and then they'll repeat an investment and say we have 2 Chinese investments. They're actually the same company. One's a subsidiary, and the host countries don't understand that. So in the NN case, the initial advertising was for a much larger project than was actually ever going to occur. That wasn't the Chinese side's fault, but there were people who were disappointed that all that money wasn't coming into the county because somebody locally had said the wrong thing. On CFIUS, I also totally agree with Melanie, and an example is the Micron trial balloon. If you saw Xinhua saying, oh, we're going to buy Micron, all of Micron for $23 billion, that was not supposed to be, that was a test to see what the U.S. reaction was. The initial discussions were for a minority investment or for parts of Micron, and they said, well, what would happen if we bid for all of it? And the answer was, you're not getting all of it. So, that's a lot better than running down the whole process and causing a big incident. The Chinese are getting more sophisticated. One thing I would say, and I talk to CFIUS all the time, we're moving in this direction, but we haven't gotten there yet, to treat like there's a China. Everything is China. And then the next step is private China and state China. And those are now we don't have one box for China, we have 2. So we understand all of China. No. New Chinese firms are investing in the U.S., have no experience globally. They are a higher risk to violate U.S. law, not because they're coming in here trying to violate U.S. law, but because they're new investors. You have to look at the pedigree of the investors that you're talking about. You have to understand shifting Chinese policy if you're worried about anti-competitive behavior. So we have improved. We've taken step 1 on both the U.S. and the Chinese side. I think now the U.S. side needs to be a little bit more sophisticated about who we're dealing with. And it's not that CFIUS isn't aware of this and they have no idea what's going on. It's just they have a lot of things to do. This doesn't happen overnight. But I think we're going to get to a period where we normalize Chinese investment in the U.S. We have an understanding of the range and variety of Chinese firms. We treat them better. This is the kind of matching differentiation you were talking about, but in the screening process where CFIUS knows, I know what this Chinese firm is. And sometimes there are Chinese firms buried in Bermuda shell companies and, for tax reasons or because they're actually trying to hide what they're doing. And it takes a while to figure it out. But I think when that happens, the CFIUS process is going to become an afterthought. And we're already seeing experienced Chinese investors doing extremely well in the U.S. We've seen an explosion in Chinese investment in the U.S. in the next few years. We're going to continue to have problems because now inexperienced investors are going to come here and not talk to CFIUS and not do the right thing. But that's not about China. That's about those Chinese investors. And that's what I'm trying to have a conversation on the Hill and with CFIUS about. There's a Chinese company that's going to screw up. It's going to happen, and they're going to screw up in a big way. That does not mean China screwed up. It means the company screwed up.
And also that, when you mentioned the Goose Island example, and Melanie talked about the San Francisco China office and Seattle China office, that there's also, I guess, an also important trend that the cities themselves or the states have to become more sophisticated and smart. That you can, and that I actually am feeling, it's funny because, Melanie and I started talking about this kind of work, a few years ago, and the landscape has really changed. And this kind of sophistication, because you can't just depend on CFIUS to know. But how do you feel about with the Chicago, like with the Goose Lake thing? They're specifically targeting Chinese investment for this, and how are they making themselves smart vis-a-vis the landscape in China?
Well, so Chicago's a separate thing from Illinois, right? So since Chicago's like 50% of the Illinois economy, I think to generalize a little bit, since we've talked to quite a few states in the Midwest to kind of just survey what they're doing and how they're doing it, I think one thing that's a big no-no is that states tend to have a kitchen sink strategy, right? They just say, hey, we're Illinois, come to Illinois. Yep. Or we're Wisconsin, we're great, we have cheese, come to Wisconsin. But that doesn't really resonate with Chinese investors because you just have to be a lot more micro, a lot more sector-based, whether it's clean tech. Manufacturing was my example, but it could be, healthcare, Medicare, medical devices type of things. And one thing we've noticed too, that a lot of states have pretty robust export promotion functions. You know, come and buy our corn in Iowa, come and buy our things in state X, but they don't necessarily have a dedicated investment strategy or investment capacity. So that's something that they really need to beef up in terms of state capacity. It's just, you got to have full-time people. If, again, it's under the presumption that the state believes that Chinese investment is a good thing for the state. If you don't think that's a good thing, if that's not your underlying premise, then you shouldn't even think about it. But if that is your underlying premise, then you need to think about, you know, do we need to actually change some of our export promotion strategies to kind of inbound investment strategies? And I think the third thing I would say is, you know, the states, they tend to go on these big delegations to China to do you know, trade shows and road shows, and they go to a lot of banquets, as we all know, in China, and then they shake a lot of hands, but they don't know whose hands they're shaking.
Right.
They're not necessarily shaking the right hands, quote unquote right hands. And so I think having just a better understanding of, you know, be targeted, you know, sector first, but then within that sector be more targeted. And it's better oftentimes to talk to actual Chinese investors
Yeah.
than your local mayor in China, who will just say, yes, great, you know, we love America, you know.
I love cheese.
And,
They do like brie more in China.
yeah, so I think so there's just a number of ways that these states can you know, can boost their capacity, you know, California may do a lot better, you know, Washington and New York, simply because they're bigger states, but, you know, there are a whole lot of investment in a lot of different parts of America that could prove really attractive, but these states have to sort of you know, bring up their games.
Can we trust them to ask questions now? Okay, I think, okay, there's microphone being handed because this is being recorded. Okay, hi. And please say your name and where you hang out and your question.
My name's Linda Recht. I work at the State Department. I just wanted to know about the impact of the drastically lower natural gas prices in the U.S. On attracting investors for manufacturing.
That's a good question. I mean, the Chinese, in terms of, and we heard both my colleagues reference this in different ways. Some of this is extractive investment. In other words, the Chinese want to come here, get a technology, get a manufacturing process. And I mean technology writ large. I don't mean advanced technology. I mean a technology that's new to that industry for China, and take it back to China and build there. And if they're paying a fair price for it and the asset holders want to sell, that's the American economy, you know, at least until people like Melanie take over and it's a state-run economy. But right now, we allow private asset holders to sell. I don't have any problem with that at all. There are people who screech about it in the media. Melanie is not one of those people, let me just clarify. But I think that's not a reasonable view. But there's also investment where the Chinese are increasingly thinking, and we see this in China very clearly, that it's not associated with the U.S., we need to get out of low margin investment because our labor costs are not that low anymore. Our land costs are definitely not that low anymore. Our energy costs are terrible. They've always been bad. Now they're even worse compared to the rest of the world or much of the rest of the world. So where do you go? Well, the obvious thing is you move your textile factories to Bangladesh or whatever. But energy intensive investment, this is the best place to invest in the world for everybody, because we haven't gotten our act together on energy exports, unfortunately. And even when we do, large volume energy transport adds price. So you've got a major energy and also, compared to most of the world, cheap land here. So labor is still expensive, but energy and other land-based resources are cheap. You're going to see the Chinese looking at energy intensive manufacturing here. So chemicals. There are places in the U.S., the Great Lakes states, that have a lot of water. A lot of places in China don't have a lot of water.
Yes.
A lot of water-intensive energy manufacturing. So it's going to take a while. Melanie's referenced this. Manufacturing plants don't have that quick return. You're supposed to be producing for a while. The plant's supposed to have a long life cycle. A lot of Chinese investors struggle a tremendous amount with actual depreciation because they don't measure depreciation properly in China at all. And you come here and they're like, there's actual depreciation. How's your plant going to depreciate over time? And they just look at you like, I have no idea. I have the same number of workers. There's no depreciation. Not the way that works in the U.S. So it's a hard thing. But if U.S. energy prices stay low and lower than the rest of the world, and for better or worse, that's the trend right now, you're going to get Chinese energy-intensive production sort of slowly moving in here. It's not going to be quick like the Koreans can move quickly. They're more familiar with U.S. environment, but it will happen. And I think that's a good, I mean, Damien said this, is a good foundation for the relationship. You don't just have the Chinese saying, great, a new manufacturing technology, I want to take it back to China. Again, I don't have a problem with that. But if that's all of it, it starts to look like it's one-way flow. As we get more, and I think we'll get some at least, Chinese energy-intensive manufacturing in the U.S., I think that's a positive for the relationship. I don't think it's going to happen quickly because it's a difficult environment to try to navigate. It's quickly on a large scale, I should say.
To add to that, on our map, we have 3 projects in the pipeline, proposal pipeline, that are natural gas to methanol projects in the United States, about $5 billion worth of Chinese direct investments, one in Washington State, one in Oregon, and one in Louisiana. And so that's an example where you're taking U.S. natural gas, turning it into methanol, and exporting that to China. And I asked my colleagues to assess those projects and really look at, do we call this a clean energy project?
Yeah.
And I would say my colleagues have a high bar on that. But the answer was yes, because it is a much cleaner production process for methanol than coal. And what China's using in China is coal to methanol, and this is replacing that. So, if we can utilize the comparative advantage we have, which is cheap and abundant shale gas at the moment, and use that to help China, replace some of the coal production processes, the end result is a net reduction in carbon emissions and more jobs in Washington State, Oregon, and Louisiana. And of course, it's up to the citizens of those states to decide, do they want that production process in their region? Is it clean enough locally for them? And thus far, it looks like Washington State said, great. Oregon had a few more questions. Some people in Oregon are still asking questions about the water usage. They're also actually kind of pushing the Chinese company, what are the wages of those jobs? You say you're bringing in jobs, what are the pay rates going to be? Let's discuss. So it's fantastic. You have these local communities on a project-by-project basis saying, okay, how much money, how much water are you going to use? Let's look at the impact assessment. When you say jobs, what kind of jobs? If the local communities are okay with that, then it can be a good thing.
That coal to methanol, I mean, I'm glad you mentioned that, it uses lots of water. And so that's kind of this, because China has these both water and energy choke points. And so that's kind of exciting to hear. But it's not really developing a new technology, this natural gas to methanol. It's an existing technology, or is it one that's going to be
So it's
improved on?
interesting. The Washington State project could be really intriguing because the Chinese partner is the China Academy of Sciences. And so the China Academy of Sciences is interested to have kind of an extension which would involve some joint research and development on some new technologies in this area. So some of these projects can be kind of a force multiplier because they create really interesting partnerships. A lot of Chinese investors are interested in Washington State because they have the National Renewable Energy Laboratory and a hub of U.S. science and technology expertise, particularly on energy. So you can have some add-on projects that might lead to technology cooperation. In this case, my understanding is they're employing an existing technology solution in new place.
You mean you had a comment?
I was just going to say another example on natural gas in the supply chain in Texas, where Melanie's from. In small town Gregory, Texas, Tianjin Pipe, which is a big state-owned enterprise, local state-owned enterprise. They dropped north of $1 billion in a seamless pipe manufacturing facility there, in part to ride the U.S. shale boom, right? Because the shale boom has been kind of elusive in China, and they couldn't sell their pipes in China. So these pipes are seamless pipes that have to do with fracking. That's what you use for fracking. So in part they did this was because we slapped a bunch of tariffs on seamless pipe exports because they were dumping them, and Tianjin Pipe got hit pretty bad. So they thought, well, maybe we should just go invest in the U.S. instead of getting tariffs slapped on our pipes. So that's exactly what they did. And so it's not new technology, but it is manufacturing, and it's in a state that happens to have a lot of energy-related supply chains. So,
I'm just going to say one thing because we're in Washington and I have to, which is, we did this to the Japanese in cars. We have a lot of problems with Chinese dumping, real problems with Chinese dumping. There are going to be more cases brought up. And I'm not taking a position. It's case by case. Some of the cases are justified in my view. Some of them are unjustified. But if we're going to impose tariffs, whether it's justified or not, guess what? That suddenly becomes a boom area for Chinese investment in the U.S. I I mean, it's just the way it is. Tariff jumping is a big part of investment motivation. So taking no position on who's right and who's wrong and which industry or anything like that, if you see the U.S. impose tariffs, you should then watch for Chinese investment in the U.S. to follow right after that, because that's just the way that's the way the world works.
It's not free market, right?
I'm not endorsing it. I'm
right.
saying it as an empirical fact.
Okay, I have a gentleman in the far back corner there, Larry, behind you, and then we'll bounce
Gene
up here.
Shin, Voice America. Last week I talked to Dr. Caesars on the phone regarding the micron issue. So I remember you mentioned that the China probably have no such a strategy for the outbound investment, and in the energy sector like this sector, do you think China has a specific interest in energy, in the U.S. or so? It's more for profit or for technology or so? On the other hand, also the regulation side in the U.S., what would be the concerns for the investment from China in the U.S. energy sectors?
Okay, maybe to go deeper than you did in the presentations.
I mean, I think I'll take, I know Melanie can certainly speak to both of these, but I'll take the first one because it's a point I like to make. Chinese firms are not used to, one, rule of law, or two, this is sort of the good thing about the U.S., or two, American litigation society, where as soon as you break some local rule, you get sued and the government sues you on behalf of its citizens or whatever. That's my point about inexperienced Chinese investors. I would be shocked, given the volume of Chinese investment that's now coming into the U.S., which is much higher than it was 4 years ago. So we've just had the surge, if we don't have legal problems with some Chinese companies. They don't know how to follow the laws. They think they didn't have to. They got some sort of exemption. We're creating jobs in this area. Why would this law to apply to us? What do you mean we have this accounting disclosure at the local level? You know, no one told us about that. There's just too many Chinese companies, too many projects, and to be frank, too many American laws for this to end well for everyone. Again, what I would say is that's going to be a case-by-case situation. Here is a Chinese company that broke the law. It doesn't mean that all of them are going to break the law. And hopefully, after we have this incident, and it's going to happen, and it's going to cause a fuss, people will learn, and they'll say, aha, let's figure out what happened here. So I think U.S. regulation is extensive enough, and it's foreign enough to a lot of Chinese firms. Remember, these are not all veteran investors, that we're going to have problems on the regulatory side, whether it's discharge and energy or something else. But I also think that we'll learn from that, and Chinese companies will improve their performance. Again, I don't mean to tread on energy in particular, but if you look at Chinese behavior, the time pattern of Chinese investment overseas, you see mistakes and you see clear learning from those mistakes. So there's going to be a mistake here. It's going to be ugly for a little while, and I think Chinese companies will learn, and we'll get sound Chinese following of U.S. regulations in general.
And maybe some of them will actually want to hire a lawyer. That's, it's a lot of times we found that the companies come in and don't have the kind of accountants, the lawyers, or even the lobbyists to help them figure out. I mean, what's good is that, Melanie, you all have given some examples of some really savvy companies, but there are plenty of other stories where they were not so savvy. Melanie, some other comments?
Sure, just to add to that, in terms of why Chinese companies invest in the U.S., what's great now is it's all diversified. People are making business decisions based on their individual business model and the opportunities that they see in the region of the United States where they're focusing. So it runs the gambit. Some companies like CNOOC or Sinopec, they want to acquire an oil or gas asset. Some companies like BYD, they want to sell electric buses to U.S. mass transit authorities, and they know that the mass transit authorities buy buses made in the U.S. So if you want to sell to them, you have to make them in the U.S. So we've seen some Chinese solar panel manufacturers come to the U.S. and build a solar farm so that they can install their solar panels and help demonstrate that technology. Goldwind, the Chinese wind turbine manufacturer, has built wind farms in the U.S. so that they could deploy their own wind turbines and demonstrate that they work quite well, so that they could build some investor and consumer confidence. The smart Chinese firms that use that latter strategy of building projects to utilize their own components and showcase their components tend to make the project very much a U.S.-China component project. So Goldwind built a project to showcase their wind turbines, but they bought the towers from an American company. so that American companies could also be benefiting from the construction. There are just a lot of different business models. I think that's a wonderful thing, because it's not that the Chinese government has a top-down, strategic objective here. It's that businesses are making business decisions, and that's something that I think the U.S. can really understand and support. And in terms of security, I completely agree, with what everyone is saying. The biggest risk is not understanding how to operate in a legal culture. So the U.S. has a legal culture. We have a lot of lawyers. All companies and think tanks, and the State Department has its own lawyers. So Chinese companies that don't hire expert legal advice from the very beginning tend to get into trouble. We hear from a lot of lawyers in town that their Chinese clients come in once things have fallen apart. Once they've already encountered problems and they've angered people in Washington and Illinois and all around the United States. That's a very difficult problem to fix. I know a lot of Chinese firms, they want to be economical and not spend those high legal fees on expert legal guidance, but that's the way we do business here. We have a legal culture, and it's really it's going to be impossible for most Chinese firms to figure that out without local assistance. And I understand it'll take some learning time to adapt and figure out that right market strategy. I think by now we do have these expert leading companies that are showing the way. Personally, I thought it was really cool that Sanyi and Rawls Corporation sued the U.S. government to get more information on their CFIUS case. We might not, that might not be an ideal from a U.S. government perspective, but that shows that Chinese companies are starting to understand how to work within the U.S. legal culture. If you don't like a CFIUS decision, take them to court and see what kind of information you can get to explain that decision. That's how we operate here. And when you see Chinese companies operating in that way, I see that as a really great, a great signal that we're starting to have some really important learning.
And then there's Wanchang, which is basically a Chicago company now. They've been there 10 years, but they sued against their CFIUS case, and they won, right?
You've had these, and Wanchang has, I don't think they
20 years.
yeah.
23, wow.
They've cleared CFIUS processes. They've had cases that were challenged, and they cleared. They made it through. So as we have these companies working within the U.S. system and having some great gains, I think it helps really show it's not that the system is biased against Chinese companies, it's that Chinese companies didn't know how to play the game. And there is a special U.S. game to learn.
Okay, and then right up here, you have to wait for the microphone. Ilaria's running up for you. Make sure you introduce yourself.
Yeah, thank you. I'm Chi Han from Xinhua News Agency. Thank you for your 3 wonderful speeches, and I'm lucky to have conversation with Derek about the Chinese investment. In fact, I have many questions, but I think a lot of people have a lot of questions, so I just ask 2 questions. My first question is that just said that for Chinese companies, there are very different kind of Chinese companies, and I think that situation is different, especially from private Chinese companies and the state Chinese companies and those central huge Chinese companies. So my first question is that when I'm talking about with Chinese companies here, for those private companies, they do not care much about the service. But for those state companies, especially the central huge Chinese companies, they care much about it. They think they are very difficult to pass the service. So do you think
CFIUS, yeah.
CFIUS, yeah. So what's your suggestions for those huge Chinese central companies? To what kind of information or what kind of things they should pay attention to pass the CFIUS? My first question. The second question is that you talk about that different states have different policies, and now a lot of Chinese companies are newcomers. They are not familiar with the business environment here, and also because different states offer different policies. So some Chinese companies used to told me that the most important thing is that you need to find a good agent and also know the state policies. So what's your suggestions for them to find good agents in the U.S. for different states? Thank you.
I mean, I'll take at least a crack at the CFIUS question, and we've gone sort of macro to micro, so my colleagues can obviously answer the local question. we have a model. We have a great model, which is CNOOC, Unical, CNOOC, Nexen, which had U.S. components. And CNOOC, Unical, CNOOC stunk. It's like, we have the highest bid. We don't have to pay attention to anything. We don't have to tell you what we're doing. We don't have to talk to anyone. We don't have to do anything. It was just awful. I'm not saying the U.S. was right to then reject the deal. I mean that CNOOC's performance was absurdly stupid and self-defeating. And CNOOC Nexen is night and day. And it's 6 years later, essentially. They're much more out in front. They're asking people, what information can you provide? Melanie already gave an example about drilling, offshore drilling. They were the same way with the Canadians. The Canadians were very nervous about this deal. By the way, CNOOC overpaid by about $4 billion, so that also helps. But we've seen a giant Chinese state-owned enterprise, which was rejected out of hand in this kind of random, disturbing way where you don't know what's going on in the U.S. and they just say no. And we've seen that giant Chinese state-owned enterprise, which has a bad reputation. If you ask members of Congress, name one Chinese company, a lot of them will just name CNOOC and Huawei, the ones they don't like. And it still was able to clear the U.S. process because it handled things very differently. So there are experienced, successful Chinese investors, even at the central state-owned level. I mean, Sinopec has investments in U.S. shale as well. That understand the process better now. I don't think the problem is centrally owned, very large state-owned enterprises by themselves. There are issues with them. How heavily are they subsidized? There are issues with any Chinese company buying advanced U.S. technology. But I think a Chinese state-owned enterprise, which has more resources, has more experience, has advantages over a private enterprise as we get to the local level, and those counter the sort of distaste the U.S. has for SOEs in general. So if you do your homework and you learn your lessons as CNOOC did, I think even a giant Chinese state-owned enterprise at the central level can make most of the investments they want.
And Derek, isn't it also true that, I mean, be it the SOEs or the private ones, that having a good joint venture partner here, a U.S. partner, is that also been a good determinant? Like, I think of the Texas example,
Well, I'd say
that they work with a U.S. company that, in theory, should be kind of, able to kick their Chinese partner to do the right things as well.
The politics of that, I don't want to endorse this. China has done this to American firms for decades, and I don't want to get on the same train here. You shouldn't have to form a joint venture.
Okay.
It should be an open market. It is true politically, as a fact, that if you say I'm taking a 20% stake, if China had said I'm taking a 20% stake in Micron, not the whole thing, get a totally different reaction. So as a political fact, it is true that joint ventures are easy to swallow politically than takeovers. I wish that were not true, because economically that doesn't make a lot of sense. But politically it is true that if you have a joint venture where there's an American partner to like keep you under control or whatever it is we're worried about, or maybe it's reciprocity because it's hard to, outright acquisitions are hard in some Chinese industries, then it's easier politically. It's not better economically.
Okay, that's good to know.
yeah, and just to clarify, state-owned enterprises have different rules. Because if you read the detailed CFIUS legislation, it says one security concern, the primary concern is foreign state control of U.S. assets. So private companies, they have much more freedom. So a private Chinese company can acquire 100% of U.S. oil assets and get CFIUS approval, but a state-owned enterprise cannot. It's just a different game. And then, the question about good agent in the United States, I think the best, a very good strategy would be to start with the state economic development offices. Each state in the United States has an economic development office whose job is to support this type of investment project. And those offices can create special incentive policies for good programs. They might be able to give a $5 million grant to support the project. They might be able to give a good tax policy. They'll know the leading companies in the region, or they'll know, for example, the Washington State Economic Development Office can tell you the port of Kalorama is a strategic location for a methanol plant, and they can probably offer discount land. And by the way, they have an empty building that you can use. They have they control those state tools to support Chinese investors, and they're a great starting place. Legal representation is also very important, but that probably can come in at a later stage of the project. I think our biggest opportunity would be having more direct meetings between state economic development offices and the individual Chinese firms that make sense for that state's needs. And I think at this point, we do need a little bit of help to make that connection, because not any Chinese, it's not the case that every Chinese company, it would make business sense for them to invest in Illinois. It's a shorter list that would make the most sense. And what we have right now is through the U.S. Foreign Commercial Service, state governors and economic development offices go to China and they fill the room with companies. And, you know, like Damien said, they're shaking a lot of hands, but they have no idea who they're meeting. And the Chinese companies have no idea, you know, what about Illinois, for example, would be great. So we need to do a better job on the U.S. side at helping make more targeted introductions.
We're good? You don't have to.
Just 2 points. One is, I think, in terms of the difficulties or lack of difficulties of state-owned enterprise investment versus private investment, I think the type of investment matters a lot. If you're talking about, like I said earlier, just pure mergers and acquisitions, meaning you come in and you inject capital and you buy the company, that happens. But I think people tend to like the greenfield and the brownfield a lot more because you're putting in a physical asset, and you generally are either sustaining jobs or creating new jobs, right? The problem with M&As, especially in sort of labor union-heavy states, people are worried if the Chinese come in, or any Japanese, German, whatever, come in, they basically buy up the company, acquire it, and then they're afraid that maybe they'll fire everybody, and then they'll take the technology back to China. Yeah. So that's just inherently more politically more difficult. Whereas if you do greenfield, you have to build something, and it's harder to kind of destroy the plane that you just built because you already invested a lot of money in there. So that type of investment tends to be easier, and states and localities favor that more because it actually creates jobs. Second point, I think on what the states and also not just states but the major cities, economic hubs can do is, I think one way is to kind of think about an idea like a one-stop shop. Right, so you as the state government, if you can, kind of find a way to have a thing so when some investor, it doesn't have to be Chinese, but let's use Chinese as the example since we're talking about Chinese investment. But they come in and say, okay, I'm interested in this opportunity. Now, what do I need to do? So then the state government or municipal government is like, here's the legal firm you need to talk to, here's the consulting firm you need to talk to, here's the site selection manager you need to talk to. So essentially like a kind of a compendium of things that any investor needs to do to actually get this investment through. So I call it a one-stop shop, but it could be anything, but something like that.
I know.
I mean, I have tried to be good. I really have. But there's going to be some political objection to some of the things my colleagues have talked about, and I don't mean to add too much. I'll just give an example, and I know Damien is aware of this, and I don't mean to say like he's endorsing this. I do not want state government saying, here's the legal firm you should talk to. That is the government handing business to a private entity. So these are good ideas. I don't disagree with the ideas here on providing information. That is a role for the government. It's a role for the federal government. It's a role for local governments. Implementing that is difficult. I'll give another example. Melanie wants energy to be treated, distinctly. I don't want Select USA to be picking out sectors that are good for foreign investors. I don't want that. So we have a philosophical difference on the panel. We all agree.
Why is it you don't want Select
Because
USA?
it's not the government's job to determine that energy is a good sector for foreign investment. The government should be providing general information without bias towards sectors or states or firms. And so implementation of greater U.S. information provision, which I'm in favor of, is not as easy as my colleagues sometimes make it sound, because crazy right-wingers, and I'm one of them, would come along and say, why do we have Select USA for energy? I mean, what's so great about energy? Keep your nose out of which sector should get foreign investment. And so we all agree that the U.S. could do a better job with the information environment. I'll just say philosophically, some of the suggestions would run into some political opposition. And, to be frank, if you have a Republican Congress now, you could have a Republican administration, you need to think about what programs are sustainable across administrations, because I don't want, and I think my colleagues agree, you don't want the U.S. to set up one kind of framework and then a new government comes in and goes, forget that. Because as Melanie said, neither investors nor politicians like surprises. So you want something that's politically sustainable, and there should be government programs providing information. We have to be careful sort of how far they go and how much detail they provide.
But what about like these more city and state level, the kind of networking? I mean, but in some ways that's a little bit more free market because it just networks to make sure that there is a meeting place, and it's not like, I'm guessing San Francisco is not specifically pitching a certain, or the Washington State example, they're not pitching specific sectors,
Yeah.
just simply,
So the problem is, under the current situation, you can get this help if you have the right connections. So if you have a lot of money and you have the right political friends, then you can organize, you can pick up the phone and you can get some federal government help to bring up your project in the meeting with Chinese President Xi Jinping, or other Chinese leaders. So basically what we have right now is an elitist assistance program. And all we're calling for is let's make that available to anybody, even people who don't have, a $3 billion project that's going to get people excited, or don't have strong political connections in Washington or strong political connections in Beijing. We're not advocating for, pushing Chinese investment into any particular sector, but rather we're advocating for the federal government to leverage what expertise it has to, if specific local governments have a demand for that expertise, then we should make that available to them. So if Kansas, for example, says, we are way behind on, we don't have the capital, we don't have the ability to move into clean energy, we have residents clamoring for the ability to install solar, we would like some help bringing in foreign investors. But we don't have a budget that we can go and hire some consulting firms to do this. Can we leverage what our nation already has to do that? I think the answer should be absolutely, because that creates more of a level playing field. What we have right now is states with money hire consulting firms. And you have, for example, there's a consulting firm called Tractus Asia that's supporting 5 or 6 U.S. states. Not all states have the cash, to have a consulting firm to get them a meeting in Beijing or Shanghai. And so we'd like to be able to, leverage, some of the existing expertise and connections that the federal government has, and make that available to some of the cities and states if they want to access that.
So addressing income inequality now goes to the extent of providing information for Chinese investment. I mean, the states want Chinese investment. They should come up with their own money. If it's worth it for them, it's their money, not federal money. I mean, this is an example of a philosophical difference. And it's a relevant philosophical difference because who controls the purse strings here? The Congress. And I'll just say the current Congress, not every Congress, the current Congress more agrees with me. And so I understand your point, but I'm just like, if Kansas thinks it's worth it to Kansas, Kansas should be able to fund a state economic development office that's sufficient to do the job.
Well, the current Congress did fund Select USA.
Yes, and Select USA doesn't have what I'm concerned about is not that the federal government provides information. The federal government is a job for the federal government to provide information, but it provides information that pushes certain outcomes. And if Select USA moves in that direction, I think it will have problems if the current Congress were still in charge. To the extent that Select USA doesn't do that, because it's just like, we just want to improve the environment for all investors in the United States, regardless of sector, regardless of state, that's fine. I don't have any problem with that at all.
So to
Amen.
beat the centrist here again, I guess.
we actually should put you in between those two.
We like each other. I just want
I actually think Derek brings up a really good point, but Melanie did those too. And even at the state level, let's get away from the federal government. Even at the state level, there are problems, political problems with picking winners and losers. I mean, that's generally how it's perceived politically. You don't want to. That the states find it very uncomfortable, and they can't really do it because of potential political backlash, and just because companies will say, well, why are you, it's viewed as sort of, why are you picking this sector versus the other? On the other hand, we absolutely need a sieve. We can't just throw everything up in any state and just say, come and buy stuff here. Or come and invest here. So you need a filtering system, a scoping system that's just a little bit more strategic. And it's not about picking winners and losers. So one way, and I'll give an example of some states that have tried to solve this. One way to do that is to privatize or spin off their economic development agencies into the private sector. They're nonprofit private. A number of states have done it. Indiana has done it, and they have by far the best record, I think, in terms of attracting foreign investment since they've privatized and spun off their economic development agency. So they got more money. They're more free to operate, but they're still in some ways helping the state in some sense. Ohio's done it, and some other states have done it. So that's one way to kind of solve both of these problems a little bit. Just bring that into the private nonprofit sector, and they have a lot more latitude to operate. And, you know, some of these are funded by, like, you know, former capital markets people, so they understand investment, they understand finance, and they're really just about investment-focused entities.
Cool. All right. Here. Oh, and then, yeah, we'll go 1 and 2, sorry.
Jim saying, 2 questions, one very technical for Derek. It's probably on your website, but is there a way of seeing where your $100 million cutoff, what industries or what sectors are more seriously affected than others? Presumably large energy acquisitions, you have a distribution of deals where almost everything's up at the billion level and you have very little down below 100 million. On renewables, I suspect it's closer to the distribution of deals comes closer to 100 million, so you probably lose more. Do you have that data, or do I have to go through your?
I mean, we have subsector identification. So you can see in energy when the transaction, if you're not familiar with it, will tell you it's oil, it's alternative, whatever. We don't track below 100 million.
But
So
can
all I would show you in the distribution is from 100 million up,
Right.
where the concentration of transactions are.
Right.
Everything below that, which Melanie has for the U.S. in energy, we just don't have that at all. So I can't give you the full distribution to show you what we're missing, because we're missing
You can't see from the shape above 100 million where you have lots.
you can see the shape, but then you can't really do it in the U.S. There aren't enough transactions to flesh out the curve. Yeah, there are certainly areas. So property is an example. Property transactions have climbed up the ladder in size, and where we were probably missing property transactions before, now we're not missing as many by volume because there are a lot of big property transactions. As you correctly indicate, fossil fuel transactions used to be very large. They're now shrinking, which I find amusing. And alternative energy used to be just completely crowded out, and that's less true now. It's still true, but it's less true than it was 3 years ago. So you can see that because we have enough transactions globally, you can see a shape of the distribution for individual sectors. You can't really see it in the U.S.
And also, your comment as Elect USA picking winners. I was looking at the website, which goes from A for aerospace to T for transportation. Are you calling for Elect USA that just talks about the USA in general without listing sectors and going into some detail for?
No, I was objecting to Melanie, not Select USA. Melanie wanted to extend Select USA, and I'll let her defend herself in a second, but Melanie wanted to extend, like Select USA is too general, we need something for energy. I'm like, I don't want that. I want it to stay exactly what you're talking about. Start with aerospace, go all the way down to zinc. I don't think we have any zinc in the U.S., but in theory, that's what I want. I want it to stay at that level.
But can I still have tabs for the individual sectors? And
Yeah, I mean, as long as you're not saying this is the cool sector, let us really help you with this, then yeah, providing basic information is good. I mean, just like an agricultural state would invite Chinese investment in agriculture by saying we do really well in agriculture. That's a factual statement, as opposed to we'll help you in agriculture versus another sector, to do two different things.
So I think our different perspectives are reflected a lot, both in our political ideology, but also the way that we approach this issue. You know, so Derek looks globally at where does the money go and sees a lot of commercial-based, you know, markets move where comparative advantages make sense. And what I've been doing is talking to a lot of city and state government officials and enterprises that, you know, if there isn't any money going into Kansas, if you live in Kansas, you don't care that there's some market reasons for that. You just want to be able to have a job. You know, I come from an area of Texas that, you know, isn't a particularly wealthy area. You know, half of your town can live or die based on one particular investment. And so, you know, I see that if for people in a particular region, in a particular state, they don't care that things are going great in California if they don't have a job where they live. And so our goal is just to say, are there any tools we have available that we should just better leverage to give more people access to them? And it's not about spending a lot of money. You know, it's more about, we have great experts in the federal government. You know, can we just help more people be able to contact them if they so desire?
So, I mean, it's more about the federal government being responsive.
Being
To
responsive.
requests from the local government.
And
I think
you have to at least have a couple of people whose job is to be responsive, not people whose job is to do something else take 1,000 extra calls on top of their normal day-to-day business. So if you're responding more to local government needs, you need to have a few staff who that's their job. But it's not about spending a lot of money. It's just about, we have this great U.S.-China energy partnership. We have all of these engagements. That's the pillar of the U.S.-China relationship. So we can just open the door a little bit and let local and state governments participate in that if they want to.
I mean, a favorite word nowadays is information asymmetries. To what extent is Select USA supposed to have a job to reduce information asymmetries?
Well, that is, the way I see it is that is their job. They're the purpose of the Select USA program is to help investors from other nations realize that there's more to the USA than New York and California. You can select a small town. I come from Nederland, Texas. You can select Nederland, Texas. There are, small towns in states across the nation that might be a great fit, for a particular investor, but they would never know. I talk to Chinese companies and they say, things like, we want to go in and buy, some technology that's like, 2 revolutions back. So they have some very specific ideas, or we want to go and invest somewhere where there's not a lot of, where there's not as much competition, where there's more demand, where we can really be a strong player, but they don't know how to find those places. So it's really hard to have actually a free market when you don't have information, accurate information about where the demand and comparative advantages are. And so our proposal is about just make that information available. So if you have underserved areas of the country, they still have to compete, for these projects based on commercial terms, but at least they can be in the running.
So maybe Derek won't be against the fact that Paulson, that you said that you're trying, that your work, that you're, focused in the Midwest, that you're trying to also, because you said, to design investor and asset matching type work. Can you maybe?
Yeah, I mean, I think to Melanie's point, it's not about extra funding. It's just simply about organizing the state better in a way that is more conducive to attracting Chinese investment. Again, it's premised on the fundamental principle that you believe Chinese investment is a good thing for your state. If you don't believe that, then don't even do it. But if you think that's a good thing, then maybe you should think about how to organize your state better to build up a deal pipeline, so that maybe so that these things can keep on coming. And again, the charts I showed, New York, California, all the big blue states have all the big Chinese investments. Maybe some of the red states would also want Chinese investment too. Again, if you again, the fundamental premise, if you believe Chinese investment is a broad new anchor foundation for the commercial relationship, then this has to be national. It can't just be in a handful of states.
Can you help me understand what you guys are trying to do at Paulson in this?
Sure.
This
I mean,
aspect, though?
one is on advising them on sort of how to
Advising who, sorry? The states?
advising the state governments in ways to again, a lot of things have already has been brought up, is how to create sort of I don't want to call it advisory councils, but sort of networked people that the interface makes a lot more sense than just simply trade shows. The interface has, we think the interface should be real investors and companies. I mean, it just makes more sense because that's how investment actually happens. The policy would be great, but that's up to the state government or the federal government. And 2 is just how to come up with a possible technology solution that solves the discovery process of matching investor to assets. Again, the state government should play no actual role in picking what that is, but it's simply a sort of, if you think about Airbnb, right? You go on and you find your apartment that you want to stay in. It's a discovery. It's a discovery process that does the initial scoping, the initial sieve that I was talking about, because you just need some sorting at the outset, because it's just very confusing for everybody if you don't sort it at the fairly macro level.
Okay. I got another question right here. Alaria, sorry.
Thanks very much. Thanks, everybody, for your presentations. Very, very interesting. My name's Virginia Cutchin. I'm an independent intercultural consultant. What that really means for me is I'm a facilitator of conversations between Americans and Chinese. And I don't advocate either side, but just a facilitator of conversations. So my question is, in all of the conversations you have with companies on the Chinese side, on the American side, at the state level, at the local level, does the question of cultural fit ever come up? And reconciling cultural differences or identifying them before they become a problem, have they become a problem? if that conversation doesn't come up, I'd like to talk to you afterwards. And if it does come up, I'd like to talk to you afterwards. Thank you.
You're definitely talking to the wrong guy. Economists are knowledge imperialists, and we think culture is this big space where people put everything they don't understand. And
You have
so-
your own culture.
We would never use that description because it's too vague. So, I mean, what I try to do, I mean, as a serious answer, what I try to do is not, assign things to culture. I try to say things like, you don't have an accounting process that's going to work here. You're going to have to show somebody your books at some point, and your books are a joke. You have it all in your head is not an acceptable answer in the United States. So, I will talk to companies, and there are obvious things like, dealing with CFIUS, it sort of gets a lot of attention, but I'll tend to talk to specific ways they function. And because, and all of us are in this, I don't mean me, but people who do this, I think reasonably well, know what the operating environment is in China. So I know, I spent the 90s working on Chinese telecom, for Pete's sake. I know how Chinese telecom firms work. So when they come here, I have some sense of the environment they're in, and I want to give them specific advice on how to deal with the situation. I don't, you can call, I don't even know how to define culture, but I am trying to actually get away from that. I'm trying to give them operational assistance. That's appropriate for someone like me. I don't know that much about the environment in local towns in the US. I actually know more about the environment in local towns in China. So just in my world, what you're trying to do is tell them where the way they function as enterprises is going to work and not going to work in the United States. And it's very specific, but that's just my world.
I think at the local level, I don't see cultural issues at all, really. I find actually that culturally the U.S. and China are very similar. We're two very large countries, agricultural-based countries that tend to be inward-looking. Very similar way of doing business, particularly at the local level, as a Texan. It's more, I completely agree with Derek, it's just whatever nation you invest in, you have to figure out what the practices are and the regulations and the rules. To the extent that there would be a difference, I would say the U.S. is a very rules and legal-driven country, and that is that's the operational principle that one should follow when doing business in the U.S., and that differs a bit from the operational principle in China. But at a local level, very similar, particularly for Texans, I would say.
I basically agree with both Derek and Melanie. I think the only time, culture comes up, it's a very, very micro level, and that's on the plant floor, is when sometimes they bring over Chinese workers and they're working alongside their new American colleagues and vice versa, or the American workers go and get trained in the headquarters of the Chinese company. Then there's some cultural communication issues, but it's nothing intractable. It's easily solvable. So there's nothing macro or broad, but just as you would incorporating German workers with American workers, it's the same idea. I think it'd be much harder with Japanese workers probably than Chinese workers.
One thought I had is that you should change your business model and start dealing with Chinese workers in other countries, because that's where I've seen Chinese firms report bigger cultural classes. They don't, when they come here, it's like, I don't understand all your laws and your political process is biased against China, and they have lots of complaints, and this is much harder than it's supposed to be, but it's not cultural. And I have, because I've been doing this for 15 years now, and mostly dealing with Chinese firms outside the US, because the US rush is more recent, I have heard them talk about cultural problems in other countries that are much bigger, per Melanie's remark, even though all of the U.S. is not like Texas, are much bigger than the complaints I've heard about U.S.-China cultural issues.
Yeah, and we do have a lot, our large Asian American population, and that, and you do hear examples of some U.S. companies that actually, they have people on their staff that speak Chinese, the first level of encryption, the language. But the Chinese folks, they come in here, they're speaking English. If they don't, they find someone who does. We've actually, most of you know that I start meetings on time, and to keep the promise and honor, since you were timely, we're going to end the meeting on time. But I want to thank my speakers. First, applause one more time for these three talented speakers. I know I want to have all of you back again, because it's so rare that we actually have some good toing and froing and disagreement, because but that's what the Wilson Center, we pride ourselves on. Thank you all for coming. You have an opportunity to gently tackle them, and we'll keep following this issue more completely. And Melanie, both of you, do you want to say anything about all you guys, all of your websites and stuff? We'll put the PowerPoints up online, and we'll put a link to the global, to the tracker, to the new CAP, and to your cool data. All right, thanks again. Awesome job. You people you guys make data collection this is how people gather,